In this learning objective, we discussed the purpose of industry analysis in valuation. So as previously spoken about the top-down approach to security analysis, whereby we come up with our value of a stock by first starting by coming up with some prediction or forecast of the macroeconomy. We then move down to our industry level before focusing specifically on the stock. So in this particular learning objective, we're at that middle stage. So in order to analyse an industry, the first thing we need to be able to do is to classify a firm into a particular industry or sector. Various ways to do this, but there are standard industry classifications. Some include the standard industry classification and the North American industry classification system. But the most common one used tend to be the GICS, or the Global Industry Classification Standards, which is a joint Standard & Poor's and Morgan Stanley initiative. And what GICS codes do is that it's a way of allocating firms into some standardised industry and sector. So we can use GICS codes as a way of identifying the appropriate industry within which the firm belongs. You can go for more information on GICS codes. You can go to the Australian Securities Exchange website, which provides greater detail. So once we've identified the particular industry within which our firm operates, then comes to the stage of analysing the industry. So the purpose of industry analysis is to identify which industries will be good for investors in upcoming environments, but also to further provide more granular information that we can feed into our forecasts associated with the expected future cash flows and the expected discount rate that we'll use in our firm valuation. So when analysing our industry, there are several areas that should be addressed or considered. We consider the vulnerability to external shocks in the business cycle, the competitive structure of the industry, permanence, the phase of the life cycle, regulatory and tax conditions, and industry financial data. So starting with sensitivity to the business cycle, there are three factors that affect how sensitive an industry will be to the cycle. Those three factors are, first of all, sensitivity of sales. So here we're looking at the extent to which sales in an industry co-vary with the business cycles, because we know that some industries, let's say the luxury goods industry, for example, premium cars, those industries, they're going to have very high sales when the economy is expanding because people have more disposable wealth, but their sales are going to decrease quite significantly when the economy begins to contract. So they'll have a much greater sensitivity of sales across the cycle, which will be a way that we can use to demonstrate the fact that this industry is far more cyclical. The second measure is operating leverage. So operating leverage is, within an industry, the division of fixed versus variable costs. We find that firms that have more fixed costs have the inability to either scale up or scale down when there is a period of expansion or contraction. Hence, those industries tend to be riskier across the cycle. We can measure degree of operating leverage as 1 plus the ratio of fixed costs to profit. Firms that have higher operating leverage, which means they're going to have a higher fixed cost base, are going to be more cyclical. Last one is financial leverage. Financial leverage is a measure of the debt used within particular industries. Industries that have greater debt, have higher financial leverage that is, they're going to be industries that are more cyclical. This is because we know that with debt as opposed to equity, you have a fixed, legally binding obligation to make interest payments regardless of the performance. So when the economy begins to contract, there is a greater risk that those industries might comprise firms that are going to default because they're using higher levels of debt. Whereas when the economy expands, debt can often become a relatively cheap form of finance, and those firms can benefit from their exposure to debt. So industries that have high sensitivity to sales, high operating leverage, and high financial leverage tend to co-vary more with the business cycle. Another related consideration is the vulnerability to external shocks. So is there risks that, for example, actions by government might have a significant impact on the industry? Or is there maybe some key dependence on external resources such as commodities within that industry, such that if there's a change to the nature of those commodities, let's say, for example, there's a big increase in oil prices, that could have a much greater effect on some industries than others because those industries might be more vulnerable to external shocks. We're also industries potentially subject to fashion trends that may soon change. So any of these potential shocks, government shocks, shocks to the price of external resources such as commodities, or shocks associated with change in tastes will affect some industries more than others. And this is another question for us to examine when we're trying to identify the degree of cyclicality of an industry. So other questions then we look at in terms of the industry is that we want to perform an analysis of whether the industry is likely to be viable in the future. Some ways we look at that is, first of all, the competitive structure. So this is a question of how competitive is the industry currently? What's its degree of saturation? So how many different market players are there within the industry? Has this changed across time? And one way we can gauge the competitive structure is identifying whether there are barriers to entry, whether there are forces that prevent new entrants into the market. A key example of this might be, say, the telecommunications industry. In the telecommunications industry, there's going to be particularly wholesale telecommunications, huge upfront capital investments to enter that industry, and that's going to create a barrier to entry. Whereas while there may be technically the potential for new competitors to enter, the huge cost associated with capital infrastructure creates a barrier to entry that's going to prevent new players from effectively entering that market. As well as capital structure, another issue to consider is permanence. So permanence is the question of whether the industry is likely to survive in the long run. Permanence has been a really important issue that has affected investors over the last decade or so, as we're seeing quite dramatic and dynamic changes in terms of consumer tastes and technology. So with respect to permanence, we want to ask ourselves, are there potentially any technological or regulatory threats or product substitutions that might affect the industry going forward? A couple of examples of permanence or firms and industries that have suffered because of change. First of all, if we think about Sony. Sony about 20 years ago had a very dominant position in the market. They released products such as the Sony Walkman, which was very popular and had huge sales across time. But there was a technological shock in that the Walkman effectively became redundant, the iPod was released, and since that time, Sony as a business has really struggled. So that was an example of a particular technological item that was maybe at threat because of change or innovations in the technology space, and we can see the impact that's had on their business. Another case study in non-permanence might be the question of the newspaper industry. So it's argued that we might be at the end of printed newspapers at the current point in time, and that's because we have new media and web-based media taking over, which is really changing the dynamics of that industry. So as well as competitive structure and permanence, another question that's often considered in terms of industry evaluation is the phase of a life cycle. Now, when looking at the phase of a life cycle, you consider the industry and where it is in terms of growth stages. So possible stages include the birth phase, this is when the industry is first emerging. The growth phase, which tends to be the initial period where there's a big increase in demand for the products or services issued within that industry, and we find significant growth in revenues. The mature growth phase is when the initial change in revenues starts to slow down, but the firm still continues to exist profitably. And then there's either a stabilisation or decline. Decline could be because of some of the shocks we've looked at before, regulatory or technological, or it could just be that the industry matures and profits stabilise through time. So once again, having a view of the industry in terms of its phase of the life cycle, but also examining the prospects of that particular industry are going to be very important considerations that factor into our valuation process and help us determine which stocks we're going to include in our portfolio if we're undertaking fundamental analysis as a process of security selection.